Here we're asked to calculate the return on sales. So my return would be the operating profit, which is 5,000, divided by my sales figure. We're told sales is 100,000 in this case, so we're looking at 5%. The asset turnover, we simply need to take our total turnover of 100,000 and divide it by our total assets employed or capital employed of 20,000. So we can see we're generating a return of 5 times the value of those assets. And for market share, we're told we're generating 100,000 of sales out of a total market of 1 million. So that represents 10% of the market as a whole. For return on investment, we're looking at the return, which is our operating profit, 5,000, over our investment, in other words, our capital employed, of 20,000. So that's a return of 25%. For residual income, we're going to need a little more room for our calculation. We're taking the return, the operating profit, 5,000, and deducting an imputed interest charge, which is based on our capital employed of 20,000 at a notional interest rate of 10%. Provided in the question. So that's an imputed interest charge of 2,000, leaving a residual income of 3,000. Lastly, we need to deal with the narrative questions. We're asked for 2 advantages of residual income as a measure of divisional performance over return on investment. So what makes residual income a stronger measure than return on investment? Well, the first 2 examples that are given to us, enabling divisional performance across divisions of different sizes and relating the return back to the size of the investment, are actually strengths of the ROI technique and weaknesses of residual income. We needed to identify that managers would be more focused on the cost of financing their divisions and that we would have an absolute measure of performance. In other words, our performance would be measured in cold hard cash, in dollars, euros or pounds, rather than as a percentage. The danger of a percentage is it can be misleading. We might be very tempted by a return of 50%, but if that turned out to be just 50p out of an investment of £1 on a one-off event, then suddenly it's not quite so tempting. So for the final part, we're asked to choose 2 non-financial measures that could be used. So I'm looking at something that doesn't have a financial value. So immediately, profit and sales revenue should leap out as being inappropriate. They are financial measures. Either of the other 2 would be acceptable as non-financial measures. For non-financial measures, we have a huge range of possible measures available to us. We can measure absolutely anything we want, anything that's useful for the business, provided we're not looking at any pound signs or euros, etc., then we're dealing with a good non-financial measure.